This course is the COMM 420 Financial Management. The goal of financial management. The goal of financial management is very simple. It is to enhance the return for our companies. This is the last course in financial management series, COMM 220, 320, and 420. We will review the theories we have learned before, and we will learn some more. Then we will apply our knowledge to analyze real-life financial problems. In this introduction class, we will talk about two things. First, we will talk about semester plan and assessment method. Then we'll share several stories of investment to gain more intuition how finance works. Semester plan and assessment method. A great challenge and a great opportunity. A great challenge as well as a great opportunity for an online course is to increase student engagement. An assessment method should strive to get students more involved. Any suggestion to enhance student involvement will be greatly appreciated. Semester plan. The semester is roughly divided into two segments. There will be a group presentation at the end of each segment. Together, there are two group presentations. Each presentation is due on Monday of that week. There is also an individual essay due at the end of the term. Selection of presentation topics. There are suggested topics from each lecture. You can also use cases listed on the syllabus. However, you don't have to be bound by the suggested topics or cases. Instead, you may consider topics that you are most interested in or most familiar with, but may not be very familiar to others. In other words, you want to choose topics that your audience will benefit most from you. Assessment method. There are two group presentations, each worth 30 points, totally 60 points. Participation mark is 10 points. Final essay of at least 1,500 words to be finished by each individual, 30 points. Together, three parts add to 100 points. Presentations. Group presentations should be recorded as videos. Each video should be at least 30 minutes long. You can either upload the video on YouTube or any other way accessible by the rest of the class. Your video should end with a question related to the presentation for other students. The question can only be answered after watching the video. The question should be written down clearly. You can also give the questions separately as documents. Grading of presentations. Each group presentation will be graded by all the students not in the group. Some people assign grades for the whole presentation group. Others assign grades for each presentation student. Either way is fine. Please send your gradings to me. The grade of each presentation is the average of all grades. Participation mark. Please send me the answers to the question given at the presentation when you send me the presentation grading. Total participation mark of each person is based on the numbers of grading you submit and the answers of questions from the presentation. Final essay. Final essay is individually based. It contains at least 1,500 words. Each can choose any topic that is related to financial management. The due date of the final essay is April 20th. Overall grade. The average grade of a fourth-year course should be B+. The overall grade will be scaled to this level. More detailed discussion later. As the term progresses, we will discuss more details along the way. Whenever you have a question on anything, please ask. I will clarify. When you ask a question or give comment, you help the whole class. Others may have similar questions as well. Any interaction will help me gauge the situation more accurately. We can communicate with email, audio, or video. We are going to talk about some stories of investment. We are going to talk about some examples from Warren Buffett. The first story is about how he bought Berkshire Hathaway, the main vehicle of his investment. The second story is about how he bought Geico, an insurance company. The third story is about how he swapped P&G shares for Duracell, a battery company. Berkshire Hathaway. Berkshire Hathaway was once the largest textile company in US and in the world. US was once the manufacturing center of the world, but it has been in operational loss for some years due to foreign competition. As a result, its share price was significantly lower than its liquidation value. Warren Buffett started to accumulate Berkshire Hathaway stocks in 1962. He bought 49% of its shares and took control of the company in 1965. The average purchase price of Warren Buffett was around $14 per share. The company's working capital was around $19 per share. This is significantly higher than the share price. In the 10 years before 1965, the company lost about $10 million. Total share number was about 1 million. This means Berkshire Hathaway lost about $1 per share per year in the last 10 years. Discussion. Suppose the liquidation value of a company is $20 per share. On average, the company loses $1 per share per year in the last 10 years. What would be the share price of this company? We might expect that the share price would be at least $20 because the company can be liquidated at this price. However, the company may not be liquidated easily. Employees are going to resist. Local communities may be angry. Governments may intervene. Your ability to handle this and other issues will determine your valuation of the company. Different people will have different valuation for the company. Warren Buffett bought a company. He closed down the textile business. Then he used cash to invest in financial assets. This was the beginning of the stellar performance of Berkshire Hathaway for more than half a century.
Leveraged buyout. In 1980s, there were many leveraged buyouts. At that time, many companies were underpriced. There are two reasons that may contribute for the underpricing of the companies. First, high oil price means profits shift to oil producers instead of oil consumers. US was a net oil consumer, the biggest net oil consumer. Second, high interest rate, a way to combat high inflation rate, makes future earnings less valuable. Later, both oil prices and interest rate dropped sharply. Operators and managers borrow large sums of money to buy underpriced companies. Some sell the assets and liquidate the companies. These transactions are usually financed by bonds. Since those bonds carry high risk, their yields are high, they are often called junk bonds. Many of those bonds were issued by Michael Milken. He was called Junk Bond King. Mainstream media are generally negative about leveraged buyouts. Michael Milken was eventually charged, convicted, and served a prison term. Let's briefly talk about the idea of Michael Milken. When Michael Milken was an undergraduate student at UC Berkeley, his teacher taught him COMM. Usually, risky assets mean stocks in COMM, but his teacher said bonds were neglected in theory and in the capital market. When an asset is neglected, its price is likely to be low, its return is likely to be high. There are great potentials for the bond market. This left deep impression on young Michael Milken. Later, Milken made great use of bonds in his career. This is another simple idea with great applications.
This is an article about how Warren Buffett bought Berkshire Hathaway as a reference. Our second story is about GEICO. So what is GEICO? It is an insurance company. GEICO means Government Employee Insurance Company. The founder of GEICO had a simple vision. GEICO sold insurance policies only to government employees. Government employees are usually very conservative. They rarely get into accidents. Hence, insurance companies rarely have to pay for the cost of car accidents. These simple ideas turn out to be very profitable for the business. Buffett first visited the GEICO office in 1951 when he was a 21-year-old student. Later, Buffett bought some Geico stocks and sold them 1 year later at 50% return. That was a very high return. After he sold the stock prices of Geico soared continuously. This taught him a lesson to hold stocks of good companies for long term. In 1976, the founder died. His son took over. The new heir initiated a new strategy of aggressive growth. In the market for car insurance, few drivers are not covered by insurance. Those few are usually bad drivers. Many new clients are high-risk drivers who couldn't get insurance elsewhere. Claims skyrocketed. Company ran out of cash. It was going to bankrupt. The new heir committed suicide. Buffett got the opportunity to buy a large number of shares at the rock bottom prices. After he took control of the company, he arranged Salomon Brothers to have a bond issuance for Geico. With fresh cash infusion, Geico quickly restored financial health. In 1996, Buffett bought out Geico and turned it private. It becomes a wholly owned subsidiary of Berkshire Hathaway. We like to buy stocks of good companies, but good companies are expensive. However, if we wait long enough, if we are patient enough, even a good company will make big mistakes. This creates buying opportunity. Geico is often considered as Buffett's most successful investment. Insurance business is the core of Berkshire Hathaway, and there's good reason for second-generation rich to be conservative. For further reference on the Geico investment, please check the following article. Swap P&G shares for Duracell. Berkshire Hathaway owns about 1% P&G shares. In 2014, Buffett swapped his P&G shares with Duracell, which was wholly owned by P&G at that time. The 1% P&G shares worth about $47 billion. P&G injected $1.7 billion cash into Duracell before the swap. Duracell was valued at $3 billion. Benefits of the swap. First, Berkshire Hathaway avoided paying capital gain tax when it unloaded P&G shares. Second, by owning a whole company, Duracell, instead of part of P&G, Berkshire Hathaway reduced its tax obligation. Owning the whole company greatly reduced tax obligations and regulation costs. Public companies need to pay annual fees to listing exchanges and pay auditing firms higher fees. The entry fee for New York Stock Exchange is about $500,000. The listing fee for New York Stock Exchange is up to $500,000 per year. Management in public companies are under more constraints. With good management, private companies can generate higher returns.
Warren Buffett turned many public listed companies into private companies. This is probably the most important reason why he can generate higher return than average publicly listed companies. But shares of public companies are more liquid. People can get rid of shares of public companies easily. In many cases, people cannot liquidate their shares in a private company easily. They often have to incur substantial loss when they do so. To own whole companies, it requires great management skill. You prefer to work in a large organization where you have a small stake of a large asset, or own a small company where you have a large stake of a small asset. In old time, most people work for their own families or small businesses. However, with increasingly high tax rate and high regulatory costs, less people start their own business or work for small family businesses. Government jobs and highly regulated business become more attractive than small family businesses. From We, a novel by Zamyatin, he said, the natural road from nothingness to greatness is to forget that one is a gram and to feel that one is a millionth of a ton. Most people prefer to work for large companies instead of small. The following are two reference articles about the swap. Concluding remarks. To do well in investment and finance, we need to be able to engage in non-financial activities, such as management. We also need to understand finance better. We will try to integrate management and financial activity together. These are the main goals of our course.